We traded right down to 2,700, which is the 100-day kind of the intermediate trend line support, and it was really important that the market found some support there, right? That the buyers actually defended that position, and we traded just below 26.99, held in, and then have since rallied back. And I think, look, it's a holiday week, volumes are light, so you're going to have these exaggerated moves. But one way or the other, the fact that we did hold 2,700 when we had every reason this morning to kind of pierce down through it and test even lower from there is kind of, I would take that as a positive. But look, again, tomorrow's only a half a day. Then you get Thursday and Friday post the holiday. So a lot could happen this week. But in the end, I think the market's really telling you that there's going to be this 11th hour deal, and that this imposition of tariffs and this trade war that everyone's talking about is not going to be the war that they think it is. I think that's kind of in my gut what the market's telling you.
Okay, Rick Santelli, it's almost the 4th of July, basically midway through the year. If you listen to most people, you'd have thought the 10-year bond yield would have been at 3.5% right now. Instead, we are under 3%, and we appear to be going nowhere anytime soon. What is the bond market telling us?
Well, I think the bond market's telling us that there's a lot of global economies that just aren't lifting their weight from a global perspective. The synchronized growth story obviously isn't true. It's been debunked to some extent. Now the market in the U.S. is definitely affected by not only policy infractions when you think foreign central banks, but reform infractions as well. And I think that's really an important point, because if I look at our GDP we expect in 3 weeks, or even the quarter we're in, there's already a lot of pencil to the paper that the momentum of the second quarter is going to continue in the third quarter. It's very hard to reconcile those, Brian, so you asked the perfect question. I really think it's more of a global pressure than it is anything domestic, but it's still going to affect the yield curve in a way that Fed policy may have to deal with, and therein lies the rub.
So, David, let's talk about how the yield curve then affects the stock market. You like financials down about 5%. How long have you expected them to rally with such a consensus trade going into the year?
Yeah, we're really kind of looking at this like a barbell approach. We like financials if rates do accelerate, if we do get some economic momentum in the second half. However, if that doesn't happen, we want to own some more defensive sectors like healthcare. Healthcare hasn't performed as you'd expect in this type of environment, got the good earnings visibility, and we feel like it's well positioned from a regulatory perspective. And so we would want to own both of those sectors today to kind of barbell, because there's so much uncertainty today. It's so difficult to know which way this market's going to go. But I tend to be with Rick that I think the bond market's telling us that there's more weakness out there, that globally we don't have the strength we thought we had early in the year. And that's likely to create some additional volatility, some additional uncertainty as we move into the second half.
Volatility, David, is not necessarily a bad thing, but what are you telling your clients? They're calling up and saying, hey, you know what? I've made a lot of money over the last 5 to 10 years. I'm nervous. You got all this stuff, the tweets. We don't know when they're going to come out. So how do you tell them to protect themselves when they say, David, I want out. I'm going all to cash?
Well, we would say do not go all to cash. Long-term investors should never go all to cash, but there are other asset classes you can own. You can own low volatility equity strategies. You can own liquid alternative strategies, different strategies that perform better in volatile environments, but still capture a significant part of the upside. I think what's important to note is that we're probably at an inflection point now. We're 9 years into this cycle. There's a ton of uncertainty out there. We got trade, we got currency, we've got politics, we got Fed policy. All of this is creating a situation that's not nearly as comfortable for investors. They need to be prepared for more volatility, and they need to be well diversified to manage through it.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.